All right, good afternoon, everyone. I can see the attendees list growing, so people are filing in. We'll give everyone 60 seconds or so to get settled there before we get going on today's learning session, research and design tax credits. And we're going to really concentrate on those common mistakes, interpreting its merits. Uh, so we'll give it about 30 more seconds, let people get settled, uh, and then I'll hand it over to Dawson. But it looks like we've got quite a few people in here already, lots of familiar faces, names at least, can't quite see faces. So guys, this is a webinar again today. If you want to use the Q&A function towards the bottom of your Zoom screen, you should be able to submit questions and we'll try to attack those if they're relevant during the discussion, but if not, we'll hit most of them towards the end. For now, I will go ahead and introduce everyone to Dawson Furco with CTA, Corporate Tax Advisors. Dawson, on top of really just being a good friend to a lot of us, has been one of a great sponsor and really someone who's helped us guide some of you all to get in great positions. So, Dawson's a partner and founder of CTA. He brings over 20 years of consulting experience, 15 years exclusively focused on the federal research tax credit, working with the accounting industry, small to mid-sized manufacturing, technology, engineering, architecture, and construction clients. So in his roles for CTA, Dawson is responsible for all areas of client service, overseeing CTA's marketing and business development. And Dawson is also a tax professional licensed by U.S. Treasury Department, allowing representation of tax clients in 50 states. And prior to CTA, he held a number of senior level management roles within some of the larger technology and communication firms that you'll hear of. Like I said, all of that plus Dawson being just a great partner that we've had over the years. I think everyone can relate to someone that you're able to work with as a partner and really be able to rely on. So let me hand it over to Dawson. You guys really need to be all ears on this presentation as there will be some real nuggets of gold here. And what I mean is that you could really find some free money right in this presentation. So Dawson, I'll hand it over to you and we'll get started.
Perfect. Well, Chad, thank you for that introduction, and certainly thank you for everybody tuning in the broadcast today. I'm sure there are a lot of other things on your plate of priorities, and so it means a lot that you're diving into this broadcast. I know a lot of you probably were hoping for more like something a dinner and a movie, as opposed to lunch or brunch and tax. But this is one of the more, I guess I'll use the term, exciting areas of taxation. So it will be a fun topic, or more fun topic. So we're going to talk about this thing called the research and development tax credit. And just to kind of level the playing field, my gut assumption is, as a federal taxpayer, as many others are on this phone today, I think we ultimately would agree that we don't mind paying taxes that we owe, right? It helps with the things that necessarily we're not working on, the roads and bridges and structures and protection and those types of things. But we also don't want to, again, we don't mind paying our fair share, but we don't want to pay more than that fair share. And certainly, if we are aware of areas to reduce tax liability, we'd like to know that, right? And most certainly, as a stakeholder, as a business owner, principal, et cetera, it's probably important to know that with things that you already have in place, without reducing expenses, headcount, acquiring net new clients, if there's an incentive out there, a program out there, my gut tells me that it's probably something that you're going to want to unpack a little bit further, which is what we're going to do today, because we are talking about activities, W-2 expenses, third-party contract expenses, annual purchase expenses that have already been extracted from your business, that you're going to be able to find through this program, that without changing the thing, there's going to be some incentives available to you. The first few slides before I dive into kind of the brass tacks of the legal definition or the congressional definition of R&D, I thought these first few slides are pretty impactful. In this first one, primarily, kind of use your imagination here. I know this doesn't exactly happen, but in this example, we're talking about two identical firms in every regard, number of employees, gross receipts, service lines, location, other than maybe they're on opposite sides of the street. Okay, and I don't know everybody's tax margin on the phone today, but we'll just use the 10% pre-tax margin. You've got one firm that's taken advantage of this federal research and design or research and development tax credit, and the other who does not, again, for the exact same service lines, exact same metrics in all regards. In order for the firm, the design firm, to benefit or achieve the same after-tax cash flow provided by this research and design tax credit that the other company is already taking advantage of, that firm would need to generate in excess of $675,000 in new top-line revenue to, again, realize the same after-tax cash flow provided by this annual $50,000 research and design tax credit. Again, all for doing the same things, okay? So I think you'll see from that slide, it is highly impactful, okay? I went a little bit, this will just kind of give you an idea. I want to say a couple things about this research and design tax credit. Number one is a permanently codified regulation. It's been around since 1981. It took a major change in 2003 that really opened it up to the small, mid-sized players, okay? Up until 2016, however, it was in a temporary status. It always had to be renewed. It has been probably one of the most powerful political footballs around the legislative arena because it is dollar for dollar, and as divisive as Congress is, this is one area of the code that they agreed upon. That's why they always put it as part of the tax extenders bill and grouped it in with a lot of other tax incentives. Well, they finally, again, starting January 1, 2016, they finally permanently codified this regulation. So again, why it's something you want to look at. But the credit is also agnostic to industry. So I've got a number of design disciplines here. This is on average what their gross receipts were, or I'm sorry, on average their annual wage expense. And this was the outcome of their annual federal research and development tax credit. Very powerful in the design industry, mainly because 99% of the credit is driven by W-2 wage expense, okay? As a percentage of time in the design space, more items or activities that those individuals are doing are passing what I would call the congressional definition of R&D. As a percentage of time, the designers are doing more things than a light manufacturing company might do, and because they tend to be highly compensated is why these credits can be quite large very quickly, okay? So kind of the agenda. We're going to talk about the quick test, mainly because we're going to get into some tax language here, and I know most of you guys don't think through the optic of tax. A thing that, having presented on this topic for the last 16 years all around the country, it's kind of a way to separate the wheat from the chaff. We're going to talk about 4 mistakes that engineering firms make when considering the R&D tax credit. A lot of it is just the name in and of itself. We're going to get into one important aspect to remember. Does your company qualify? And financial risk, which is unique and distinct to the design industry, okay? Chad kind of already went through this. As a founder of CTA, we are a national specialty accounting firm. We really built the firm to be an extension of your CPA. There are really 3 primary areas of the tax code that we focus on. We're not into 1120S's and 1040s and 1120s, et cetera. So we really built the firm to be complementary to your CPA firm, okay? All right, so the quick test. If I had the opportunity to be within your 4 walls today and kind of laying out the foundation of how Congress defines R&D, I would really kind of start this way. I would ask you to raise your hand to these 2 questions, or say yes to these 2 questions. And the first one is, did you do anything today that was neck up work, i.e. using your head, designing, drafting, conceiving, contemplating, resolving uncertainty, kind of all those INGs. And did you do any of those things in an effort to make something better, okay, new or improved? Because there's a great chance that if you said yes or raised your hand to those two questions, that you're going to find that the types of activities that you guys are doing on a fairly systemic basis are going to satisfy the kind of the brass tacks of how Congress defines R&D, okay? So again, did you do anything today that was neck up as opposed to those neck down types of things? Again, very important to the organization, the marketing, human resources, administration type things. They are important, but as it relates to incentivizing activities, it's going to be more of those things where you really are using your head, looking at what's not working and creating change or doing something differently, okay? One thing I do want you to remember, there are hundreds, if not in some cases, depending on the size of the firm, thousands of hours where principals and staff are you guys are incentivized to think, to draft, conceive, plan, test, and it's exactly the kind of work that qualifies design firms for this credit. Okay. So ultimately, we understand kind of the game annually is to pay your fair share of taxes, but also lessen that liability with programs and incentives out there. And in order to do that, you have to understand that number one, the federal government has your money, and you have to understand what's the best way. You know, how does Congress define R&D to determine can I benefit to get some of those dollars paid? How do you compute these benefits? How do you document and substantiate? What do you have now and what will you need later if you've never taken advantage of the credit? And ultimately, because the credit can, statutorily, it's open for 4 years. Let me unpack that here for a second. Again, it is an annual credit that is codified, something you should be looking at annually. But if you've never taken advantage of the credit, you can actually reach back to the 3 prior years for activities that have already occurred and amend for the benefit, okay? So mistake number one, believing design credits don't apply. You know, this name, research and development, when it was incepted by the Reagan administration back in 1981, it really was for those types of activities that were pushing the boundaries of known science, groundbreaking type of activity. You think patentable worthy. And you had to have, while you were doing those kind of innovative things, have a very contemporaneous reporting mechanism in place. All of that has changed, okay? Ultimately, you still have to be able to prove and show that what you're doing is improving or looking for areas to do what you do better, faster, stronger, cheaper. But it's no longer this thing that needs to be patent-worthy, new to the world, pushing the boundaries of known science. And in fact, as long as it's new to you, the taxpayer, even if there was another design firm that was breaking into a service line or a new design effort, if it's new to you, the taxpayer, it still opens you up for qualifying activity, okay? Now, I don't know how everybody phase codes their designs on the broadcast today, but traditionally, it's going to be happening in those design stages at the beginning. So the PD, DD, SD design phases, pre-design, schematic design, design development, okay? We don't find a lot, it's not to say we don't at all, but you won't have as many qualifying activities, and this will make more sense here in a second when we get through into Congress's definition of how they define R&D. So you don't find a lot in construction documents, the bidding process, and so just remember this, that most of the beginning stages, pre-design, schematic design, design development is where most of your defining R&D is going to be occurring, and ultimately, the design effort doesn't always systematically go from A to Z. Right? You figure things out midway through the process that makes you or causes you to go back to somewhat of the drawing board, back to kind of redefining your maybe it's a hypothesis or a thought or a concept, and why that R&D clock is always at some levels resetting itself. Okay. Okay. Now, these next few slides, please understand it's not an exhaustive list of types of qualifying activity, but it might hit the mark with some of the firms on the broadcast today. And because it's not exhaustive, please, after this event, after this broadcast, if you have any questions that maybe don't hit the types of activities that your design firm is getting into, we can step through it. But you kind of get the idea that it's hitting those pre-design, design development, schematic design. You look at alternative structural design, material strength testing, performing roadway simulations to determine the effective traffic patterns. You look at 3D modeling, improve acoustical qualities, improve ventilation, alternative heating and cooling systems. And this will make more sense, and we can come back to these slides so I can kind of highlight the 4-part test for you. But you get the idea that it's in those stages where you're using that kind of neck up activity, use your head in kind of answering or defining where you guys are going in the appropriate or final design from concept to final delivery, okay? In the architecture space, developing master plans, planning and elevation drawings, construction documents, efficient features, energy efficient features, etc. Okay, and again, so not exhaustive, but it gets you get the idea of where we're going here. So let's dive into how Congress is defining R&D. You know, in our space, like your guys' space, we have acronyms, and the big one that we're looking at right now is that we deal with all day long is something called a qualified research expense, a QRE. Okay, and so what you're trying to understand or ascertain over an annual work cycle, how much time are me and my people working on the types of activities that Congress defines as R&D. This is typically 99% of a credit in the design space is a W-2 wage expense. So essentially you figure out as a percentage, how much time are my people working on these types of activities? And then it's just math. You take that percentage, which is called the employee's allocation to the credit, and you multiply it by box 1 of their W-2. And that becomes what's called the employee's contribution to the credit. Okay, and you do that for everybody in the organization, and you get closer as to what your credit is going to look like. Okay. Now, there are other buckets that you're going to find QREs, qualifying research expenses. Annual purchase expenses may at times qualify. Now, you more often see this in the manufacturing space. In order for a purchase to qualify, think about it as a raw material that's purchased. Maybe it's steel, or it's an additive or a preservative. And that raw material is used, reformed into whether maybe it's a prototype, or it's for testing purposes of taste, etc. And on the design space, you probably aren't going to find a lot of purchases that are reformed into a prototype that can't be resold. You might have construction materials for scaled mock-ups of certain structures where you might be able to pull those expenses in, but primarily you're not going to find, we usually don't find a ton of purchase expense that does qualify, okay? The third bucket, really look at them as an extension of your wage base, okay? So to the extent that you hire an outside individual, an outside firm that happens to be working on aspects of a design that hit the definition of R&D, you can recognize up to 65% of the cost associated with those design efforts, okay? But still, the biggest, largest dollar or benefit is going to come from W-2 wage expense, okay? All right, so let's get into how Congress defines R&D. This is usually the time in the presentation where I say, hey, if you're ever bored, if you have bouts of insomnia, I'm going to direct you to Internal Revenue Code Section 41. And really, in layman's terms, what all Congress really says is that R&D is the development of a new or improved business component. Okay, now don't get wrapped around these fancy words of business components, really what you would call a design, a job, a project. There are actually 6 business component types within every business. So you're going to have products, which you make and sell. You're going to have processes, how do you go about that product development? You're going to have software. Okay, now let's unpack software. What we're talking about in software is not the capital expense or purchase of software that's readily attainable to industry, like a Deltek or a QuickBooks or a BST or whatever the case may be. Those firms have done custom coding to build their platform, and they can benefit from the R&D credit. So that, when we talk about software, what we're talking about as far as that as a business component type is if you guys are hiring an outside firm, or we have someone internally that may be doing custom coding for a platform, whether it's you're using it internally or whether it's a way for you to interact with the outside client. That's what we're talking about in the software business component. Then we get into techniques, formulas, inventions, which is the very first onset of the credit back in 1981 with those patent-worthy, new to the world types of things. But 9 times out of 10, where your R&D business component is going to be focused is on the product, on your product, what you make or sell. It's the design effort, okay? And so what this legislation says, or the language says in there, it's the development of a new or improved business component, and then it goes on to further define that that phase of the design, or that design, will qualify, and the wage expense tied to that activity will qualify if it passes a 4-part test. So this is the statutory definition of R&D that we're going to run through very quickly, okay? So here's the first test, okay? Some will call it the permitted purpose. Essentially what it says is the taxpayer, whenever I say taxpayer, think about you and your people, your PMs, shareholders, stakeholders, etc. The taxpayer is attempting to do something new or improved to that design's function, its performance, its reliability, or its quality. Okay, it doesn't have to be all 4 of those. It just needs to be, again, let me go back to the word attempting. That's a very key word. You're not doing the design for the fun of it. You're attempting to figure something out. It's either a new design or an improvement to a current design based on its function, its performance, its reliability, or quality. Okay? So if you look at this, I always ask the question, how you pass the first test is, what are you attempting to do relative to that software's function, or that technique's reliability, or that design's reliability, okay? So you're really kind of just getting into understanding that it's either a new design or improvement to a current design, which happens all day long, okay? So the first test is pretty simple to qualify for most firms on broadcast today. When we get to the third test or the second test, this is where really kind of the rubber is going to meet the road here, okay? So the second test is called the elimination of technical uncertainty, or what I'd like to title the technical risk question, okay? And what it says is the taxpayer, again, you and your people, are endeavoring to discover information that was uncertain when you started the design effort, okay? And the answer you're trying to come up with is based on the facts and circumstances. What's the appropriate and final design, okay? If you could take the scenario that you could have 4, 5, 6 different, let's say they're project managers or stakeholders or principals, engineers, etc., architects in a meeting with the paying client that says, hey, Chad, I'd like your firm to design X, okay? Those 4, 5, 6 individuals have different levels of expertise, knowledge, time in the discipline, and they're going to go back to their office, and based on their interpretation of the facts and circumstances, they're going to come up with what they feel at that time is the appropriate and final design, the best way to proceed, okay? And you're through those 4, 5, 6 W-2 wage being expensed, you're trying to figure, okay, which direction are we going to go first based on the facts and circumstances? And it's not always readily distinguishable at the beginning. And ultimately, what you figure out is the appropriate and final design today may not be how it ultimately ends up. It's those 4 or 5, it's that wage expense being, well, expended where you're satisfying this test. Now, it's on this test where I get a lot of pushback. Or I shouldn't say a lot of pushback. Just if you think about the nature of what you guys do, you've been at it for whether it's 5, 10, 20, 30, or 40 years, I'll get the question or the statement from the Chads of the world, so to speak. And they'll say, well, Dawson, this sounds great, but I really don't think there's a lot of technical risk or technical uncertainty in what it is that we do. We've been designing bridges the same way for 20 years. And I understand that, but you need to think about from the legislative standpoint that has no idea what it is that you guys do in your day in and day out basis in getting to appropriate and final designs and presenting design packages. I could, and it's usually at this time where I'll say, well, okay, Chad, that sounds great. Are you telling me that there's so much non-risk or there's no technical uncertainty that you could actually have a bookkeeper, a non-technical salesperson, someone from human resources, sit in on those factual meetings, unique facts and circumstances types of meetings, and get to an answer of the appropriate and final design? And ultimately, Chad is going to say, no, there has to be some discipline, some understanding, some expertise in the individual that's listening to get to an appropriate and final answer. And that's where your technical risk resides, okay? Now this is the big test. This test, I mean, again, although you need all 4 tests to satisfy it, but this one really kind of encapsulates the congressional intent, why this legislation exists, okay? And why it exists is to reduce the high cost of U.S. innovation. Sounds like a big word, but when you really unpack it, it's innovation is simply put as new means, new methods, looking at what's not working and creating change, information shakeup. And so it's the sole purpose is to reduce the high cost of U.S. employment, because innovation doesn't happen in a vacuum. It's us humans that are figuring out and running those innovations. Right? So it's for the purposes of reducing that kind of high cost, but not only that, it's the disciplines of jobs that the U.S. government wants to maintain, sustain, and grow here in the U.S. So the third test is called the technological in nature test. It says the taxpayer needs to be relying on the principles of a physical science, okay? Engineering, physics, chemistry, biology, computer science, i.e. software, and relying on the principles of does not require these individuals to be formally degreed, certified, or licensed. You just need to be relying on the principles of that physical science, as opposed to more of the behavioral sciences, you know, aesthetics, taste and feel. These are the jobs. These are the know-hows, the disciplines, the expertise the U.S. government wants to maintain, sustain, and grow here in the U.S., okay? So again, that's the congressional intent of this legislation, is really quite packed into test number 3, the technological in nature test, okay? And finally, to round this out, it's the process of experimentation. And it says the taxpayer needs to be evaluating one or more alternatives in an effort to address the design uncertainty you had in that second test, you know, getting to that appropriate and final design, okay? In all the years I've been at this, there are really 3 factual kind of process of experimentation patterns. The first one, we all know it, it's the scientific method. You know, you have a hypothesis, you have a control group, you introduce a variable and you measure the outcome. Introduce another variable and measure the outcome. Probably more formal than a lot of what we're doing on the broadcast today. But where you guys are hitting the mark in this process of experimentation is through the evolution of the design, right? We go back to design development, schematic design, et cetera, going through the evolution of the design. And the third, probably my favorite, we all know it, is simply trial and error. You know, listing what needs to be accomplished and rolling up your sleeves and getting it done. And I want to highlight the word one. Even if you get it right the first time, it does not negate that activity from qualifying for R&D. The credit, as I mentioned earlier when we started this broadcast, is number 1, it's industry agnostic, so it's open to all industry. And the second is it's agnostic to the outcome. It's not about whether you succeed and or if there's a false start. I guess you could call that a failure, but it's about the attempt, okay? It's about endeavoring to discover information. It's about hitting, you know, all the 4-part tests, okay? So just because you might get it right the first time does not negate the ability for that activity to qualify, okay? I can get this to advance. So if you think back to that quick test, number 1, did you do anything today that was neck up, right? i.e. using your head, problem solving, designing, drafting, conceiving, contemplating, resolving uncertainty, and did you do those things in an effort to make something better, new or improved? You can see how on a fairly consistent basis, you and your folks are going to be passing the mark on those 4 tests, okay? Mistake number 2, believing your CPA has it covered. And please understand that the body of tax law, like the body of medicine, it's enormous, right? There are over, I think last counted, there were probably 9,000 code sections. If you broke it up, 4,500 on the personal side, 4,500 on the business side, just on the business side, similar to modern medicine, your CPA is probably going to understand, like your general physician, what the anatomy of your knee is. You know, they know debits and credits and audits and financial statements, okay? They know those things, but they're probably not, if you, back to the general physician, if you had to have your knee scoped, you're probably going to go see an orthopedic. That's really how we established ourselves. So a lot of CPAs might know about it, but if you look at the stat that less than 18% of industry is currently benefiting from the credit, you can see that CPAs, even though they might be aware of it, they're just not comfortable in it. They're not taking advantage of it. Now, that's not to say that 100% of industry is going to qualify for it, but there are a lot of industries. I usually say, and I'll say this now, if you are a U.S. company, you have a product or service on U.S. soil, and you're successful, i.e. you're making money, then there has to be a credit available to you. I say that so confidently because you would not continue to be relevant, a sustainable business, if you weren't always looking for ways to do what you do better, faster, stronger, cheaper, more with less. And those types of arrows that are driving you to be competitive, you're finding, if you peel back the onion, that you're doing the types of activities that qualify you for the incentive, okay? Should highlight it's open to all tax entity types as long as you are a federal taxpayer. So this kind of throws out the fully owned ESOPs. But if you are a federal taxpayer, it's open to all tax entity types. And like I said earlier, it is a 4-year open statute, meaning that you've never taken advantage of the credit. You can reach back as far as 2017 at this point in time for benefits, okay? I can get this to advance. Now this is tied to the CPA as well. This is a unique and distinct aspect of the design, the research credit for the design industry, mainly because if you think about it, you guys are paid for your expertise for the design package. And this is where, if you're taking advantage of the research credit, you really need to understand from a contractual basis where economic risk resides. And again, why, I'm not saying all CPAs, there are a lot of CPAs that do continue to take advantage of the credit. Most of them are at the big 4 or super regional firms. But if you think about the work that you guys do, like I said, you're not presenting a tangible widget, right? You're being paid for those services. And so this industry butts up against what's called a statutory exclusion. In the tax world, it just means even if you pass all 4 tests, if your occurrence happens to butt up against one of these exclusions, i.e. funded research, then it negates the benefit for you. Essentially, in layman's terms, what it says is, to the extent the design were to fail, okay, who is left holding the bag of remedying that design with the potential of not receiving further compensation? Again, why it comes down to a factual, contractual basis. So generally speaking, if you're getting involved with a paying client where you're presenting to them a fixed bid, i.e. a lump sum contract, you are establishing the necessary risk in avoiding the funded research exclusion. Okay, so you've got the 4-part test that you've satisfied, you've got a fixed bid agreement, and ultimately what that highlights is, to the extent that design were to fail, you, the design firm, need to remedy that design without receiving further compensation up and over your fixed bid. Okay. Now, I do get some firms that say, well, Dawson, listen, more often than not, majority of our contracts are fixed bid. But in the 20 years that we've been at this, we've never not been paid. How is that risk? How is that financial risk? And I get that, but it comes down to, it's a legal term. It's the potential for risk. Okay. So in those contracts, you have the potentiality, regardless of what happens over a 5, 10, or 20-year period, that if that were to occur, you would need to benefit that design without receiving further compensation. And that's why it's a good fact pattern for you. The opposite side is going to be purely cost contracts. So think about it, or look at that as an open checkbook, that regardless of the design, okay, the failure, et cetera, you're paid for your services. Then the risk switches back to the paying client. Okay, so they would be able to take advantage of the design efforts that you guys are working on because they have paid you on a time and material, a purely cost contract. Then you're going to have this area in the middle, caps contracts, time and materials not to exceed certain caps. What you're looking for there is something called risk shifting language. So where does it, this risk pivot from one side to the other? And if you employ those contracts and you have language in those contracts like warranty provisions, or inspection and acceptance clauses, or milestone achievement payments, or percentage of completion of construction, those line items read more like a fixed bid and why they may be favorable to you and move the needle back in your favor. Okay, so generally speaking, if you're on a lump sum type of arrangement, you're going to be solid. Cost plus is going to be the benefit to the paying client. I'm sorry, not cost plus, but purely cost. we're looking at the benefit of the R&D going to the paying firm. And then that area in the middle, you just have to understand how that language reads in some of those line items. Okay? Again, it's a very important aspect to understand and why a lot of accountants just aren't comfortable in it, I guess I'll say. Okay? I can get this to advance. As I mentioned, it is a specialized, highly specialized area of the code. Relative to our firm, that's why we staff degreed engineers that can talk engineer to engineer and really understand how you guys go about your design efforts, how they qualify, both at the activity level as well as at the contractual level. What we have found is that it's not that CPAs are not having the advantage or the ability to take advantage of the credits, but they tend to not be maximized because they don't understand specifically the four-part test. And what they do is they essentially present a questionnaire to the design firm and leave it to you guys to kind of figure out what is or what is not R&D based on Congress's definition. Okay. Mistake number 3, believing it's aggressive and it will trigger an audit. And statistically speaking, the current environment is less than 1%. Now, please understand, I don't have a crystal ball. I've been at this 16 years, and there was a period between 2012 through roughly 2017 where it was what was called a Tier 1 audit issue, meaning it was of high strategic importance to the IRS, this area of the code, this thing called the federal R&D. So 100%, if your tax return included the desire to take advantage of the credit, it was audited. And it was Commissioner Schulman at the time. And what they found after 4 or 5 years of exhaustive research, they did not find what they thought they would find, is that people were taking erroneous claims or making invalid assumptions, high-level estimating, okay? And so they removed that placard of the R&D tax credit, and we saw audits fall off precipitously. Then we have this permanent codification of the reg. There's more financial literacy, both on the sides of industry as well as the IRS. We just don't see a lot of them. It's not that we don't see them, but traditionally, when we do see them, they're credits in excess of $250,000, $350,000 in annual credits. You think about the IRS built like a business. They're going to get their bang for their buck, right? So they're not. It's not every credit. It's not every business. And if you think about this too, the small mid-sized players are somewhat new to the credit. I get it dates back to 2003 when they revised the credit to the benefit of small mid-sized players. But think about the firms that take advantage of this credit to the tunes of millions of dollars every year, the Oracles, the PeopleSofts, the big motor companies, the Seagates. Their credits are exceptionally large. Based on their types of qualifying activity, but also because it's very much a W-2 labor-driven expense and why these credits tend to be large, okay? So again, the current environment less than 1%. 1 year, it was 5% about a year, roughly around 18 months ago. In the last 2 to 5 years, it's 2 to 3%, okay? I do want to highlight, though, the one beautiful thing about the design industry, if the IRS is ever going to review a claim, what they're trying to understand is first a qualification and quantification. So first, how did did you qualify your design effort through the 4-part test? And then ultimately, they want to know where the nexus is, where the connection is between the qualifying aspect of the design and the W-2 wage expense. And so you guys have great documentation. It's just not in a format the IRS can digest at this time, okay? There's no better industry than you guys because, again, you got good time records, good project accounting data, okay? Now, there are firms out there that highlight when this R&D tax credit changed in 2003, there was something called the discovery test. So prior to 2003, you had to prove and show that what you're doing, remember I said, had to be groundbreaking, new to the world, pushing the boundaries of known science, and you had to have a very stringent reporting mechanism in place. Well, that discovery test was, in fact, removed in 2003. So there are firms that came out here and said, hey, the Chads of the world, you no longer have to keep documentation. You don't have to have that level of detail. And please understand, you've got the legislative body and then you've got the enforcers. and it's about the interpretation of the enforcers, i.e. the IRS, that you need to be concerned with. And I'm telling you right now that you do need to have documentation, okay? But once you've established kind of the breadcrumbs, if you will, for how you design, how you go about your work, there's a significant case law that you can use estimates and extrapolate that to the rest of the universe, okay? And ultimately, if you've never taken advantage of the credit, and I won't get too much into this, it's something called the Cohan Doctrine. You weren't aware that you had to have this level of documentation in order to take advantage of it. So if you do take advantage of the credit now, you won't have to have as a robust level of documentation as you will when you start moving forward, because now you're aware of the level of documentation that you need to take advantage of the credit. But understand, you do have this documentation within your accounting system. You're just going to get more intelligent about how you code time or how you extract that time, how you document your time, okay? So I kind of just said that a project accounting system has the needed details in the documentation, okay? Mistake number 4, believing the administration burden is too great. And I get this. You know, you guys are not in the business of taking advantage of, you know, tax credits. You and your folks need to be billable, utilized, etc. So the way to look at this is how, you know, what's the return on my investment? If I do take time away from design efforts, from billable time, from utilization, what's it going to mean to me and my firm? And when you in our parlance and in our nomenclature, we call it a study. Some will call it an audit. These, on average, they take in between a 2 to 3 month period. And over that 2 to 3 month period, on average, in aggregate of you and your people's time, it's going to be in that 18 to 25 hour range. Okay, so not a huge exhaust of time. There is certainly some time that needs to be expensed by you and your staff, but there's no research, no scientific project you have to do or get prepared for this. You really just need to, I shouldn't say you really just need to. There's no preparation for you guys. If you use an outside firm, more often than not, it's just a Q&A session, sitting down and speaking about things that you already know. You know, it might be a certain design, and the engineer is going to sit down with your engineer and say, okay, Chad, tell me about this design. Was it a new design, an improvement to a current design based on function, performance, reliability, or quality? Secondly, what did you not know? What were you endeavoring to discover before you started this design effort? Were you relying on principles of a physical science, i.e. engineering? And then ultimately, Chad, what were the alternatives that you were evaluating in getting to that appropriate final design? So in these studies, there will be what I call SMEs, subject matter experts, whether those are stakeholders, shareholders, PMs, et cetera, that will sit down for 45 to 60 minutes just to kind of unpack what you're doing, so we can understand more of how your design efforts align with the 4-part test, you know, statutory R&D. So if you have 3, 4 interviews and you've got your accountant or controller is going to be extracting some data out of Deltek or BST or your project accounting system, you can see that that's how you're going to drive those hours up over that 2 to 3 month period. But again, it's not going to be something that is 8 hours a day for a 2 to 3 month period, okay? And ultimately, just about as I mentioned, we are a national tax practice. We really built the firm to be an extension and augmentation to your current finance team, as well as your CPA. We welcome their involvement through the entire process. They're still very much your trusted advisor. They still sign up on corporate returns, amended, timely filed returns, et cetera. We're really there to be the subject matter experts on the quantification, qualification, substantiation of your credit. Our pure focus and why we do so much with Zweig and Chad and Jamie Claire, this is our realm, and we service just over 220 design firms in all disciplines, so we know your space well. The one thing I will highlight or offer out there is that, in fact, why don't I have you do this? There's a kind of a quick mental calc to kind of give you an idea of what this might mean to your firm, Okay, so in your head, if you're in a position of understanding what the average annual W-2 wage expense is, get that number in your head. Take that number times 25% of your that annual expense, and then multiply that by 7.5%. That will give you a good idea of what your annual net credit is going to be. But we'd like to give you a more exacting estimate if you allow us to do that. There's no cost to you guys for us running a more exact statistical estimate for you and helping you kind of explore this a little bit further. So with that, that's R&D kind of on steroids, everybody, and I appreciate you taking the time today. Chad, if you'd like to dive into some Q&A, we can do that.
Yeah, we had a few good discussion points and questions come in throughout the presentation, so thank you guys for doing that. Let's hear from Mara first. Mara's question was, and it really was more of a scenario, so this is good for discussion. We had a firm do a study for us to determine if the R&D credit was worth it for us. Their study showed us the credit would be very small and not worth the full review. I think it was mainly based on our contract type, since we are usually a subcontractor and we're not taking financial risks. Does this sound right? Should they really revisit this? Should they get a third, second opinion? Or maybe do they need to rework some of their contracts in that angle to qualify in the future? They're a structural engineering firm, about $2.5 million in annual revenue with 15 employees.
Perfect. And there's no, outside of MEPs, structural tend to be the highly allocated to the research credit because of the types of activity you guys are doing. Depending on when you looked at this incentive, it sounds very familiar to me. But there are new case findings out there. One is called Populous Holdings. It kind of unpacks the ability from a contractual standpoint, what is and what's not financial risk. Because there is an opportunity that both what I would say a prime and a subcontractor can qualify. We go back to that kind of term, and what's the risk shifting language, and it's called mirror imaging rules. So essentially what that means is, let's say that you have a prime designer, okay, and they hire an outside firm like an MEP to do HVAC design. If that HVAC subcontractor presents to the prime a fixed bid contract, the third party, MEP, can benefit from the credit. Okay, they're the ones at risk as opposed to the prime. Now, if the subcontractor presents a cost contract that regardless of the MEP design, HVAC design, then the benefit flows to the prime. So I think based on my understanding of the contextual context of the question, it might make sense to look at it again. It all depends on when that review was done. Were they looking at, because Populous Holdings is a pretty recent case, there might be some fruitful ground to look at it again.
Okay.
Hope that helps.
I think that should. So moving on to a couple of questions about these qualified expenditures that we can get into. And I think we did touch on this, so maybe it got answered live throughout the presentation, but where does software fit into that?
Yeah, so software, I kind of unpack that though quickly in that business component type. It's not going to be something that you as a design firm did not code. If it was just a purchase of something that's readily available, attainable to industry, okay? So it's going to be software that either A, you hired an outside firm, so looking at them as an extension of your wage base, where they're leveraging computer science, it's a new software platform or improvement to a current platform that's going to be yours, or it's an internal W-2 wage expense that you guys are custom coding. That's really what it's going to come down to. Now there's an additional 1 to 2 tests in the software realm around internal use software as opposed to software that's pointed out to the world that's going to help you interact with your paying client, which we can get into offline, but it's still favorable depending on, first and foremost, who is coding the platform, which we'll probably need to dive into a little bit further. But that's the software application, not purchasing something where the work is already done and you can plug and play.
Gotcha, thank you. So just going back into these qualified expenditures again, can owners be included in these expenditures if they're not W-2 employees?
There's going to be some aspects of self-employment income depending on how you're structured as a tax entity, if you're a pass-through entity. So the answer is yes. It's still ultimately going to come down to W-2. There's got to be a number in that W-2 box, one of the W-2 to drive the contribution, if you will, to the credit. But there is going to be some aspects of the K-1 where self-employment income comes into play. So with what I understand about the context of the question right now, there's still fruitful ground for the owner. It is not taking a W-2.
Okay. So let's see, I went back through the chat and we had a couple of people that did your napkin experiment here. The quick calculation of W-2 wages they were trying to ask, is that for an annual tax credit or does that need to be spread over the 4 years?
I'm glad that question came up because I went through that so quickly. Usually I have it into the slide, and Chad, you remember I just revamped this presentation, so I forgot it and it didn't have it in there. A couple things. The first thing I asked you guys to do was to multiply that W-2 wage expense by 25%. That is a statistical average. When I talk about having us do a more exacting estimate, we've got 30 years of Treasury data of all industries benefiting from the credit, and then certainly all the clients we work with in the design space. So you will have some design firms that are maybe more in the landscape architecture that are going to be more around that 10 to 15%. Structural is going to be more around probably the 30% realm. They're going to be higher, as well as MEPs. So that 25, that's the first thing I want to mention, is the 25%, that is the variable. That's going to change, okay? And then secondly, that is a net annual calculation, okay? So if you've never taken advantage of the credit, you would take that number times 3, or I'm sorry, 4, because there'd be 4 years, right? So that is an annual net at the federal level. And the other thing I would identify is that there are 36 or 37 states that have a matching requirement to the Fed. So if you qualify, if an aspect of your design qualifies at the Fed, it's going to qualify at the state too. So there will be some ancillary dollars. It just won't be as big as the Fed. But pointedly answering the question, that is a net mental calc, annual, 1 year.
Okay.
Okay.
Great. Let's see, a couple more messages rolling in. Let's see if we got any questions here. We got some thank yous. We got a lot of testimonies from people that just saying, hey, we've done this in the past. Well worth it. It sounds like we've got, landscape design firms, structural firms, really just depending the lens you put over some of your operations. I'm assuming most firms can qualify for this. So lots of thank yous in the chat. I think you'll probably either have some quick and easy follow-up from some people who want to learn more about this. I know this can be one of those iceberg type conversations where we get out so much in an hour, but then once you actually apply it to your firm, you can see the possibilities get so much bigger. Today it looks like we had another one. You quickly mentioned that this credit wouldn't apply to ESOPs and S corps. Can you unpack that question a little bit?
Yeah, if you think about the ESOP, they're not federal taxpayers, and so it's because it's a federal liability. If you're not going to have any federal liability, it negates the opportunity, right? It's not that you won't generate a credit, you just have no use for it. There's no usability because you're not having a federal liability. If you are a partially owned ESOP, there is still an opportunity where you are a percentage of a federal taxpayer where you're going to be able to use these incentives. Okay. So it's really just comes down to, from a federal liability standpoint, because the idea is you're going to take this credit and offset the cost of that you're paying to the Fed, right? So instead of you paying $100,000 liability, if your credit is an annual $50,000, now your tab to the Fed is $50, dollar for dollar. So if you have no liability to the Fed, your credit just is not going to be used. There's no utilization for it.
Great. Well, we still have a few more questions coming in. We will actually have to have a hard stop at the top of the hour. We've got to start the next session, but we can take any questions we don't get and have Dawson either reach out to you guys directly or send a response to the group. A couple people have asked, are the other slides available? Will this presentation be available? The slides will be available upon request. So if you want that, you'll either need to ask Olivia, Thomas, or myself. But then the presentation in whole with Dawson's comments and me on here, that'll be available on our website where you guys have been using to navigate and get to most of these events. So that should be 24 hours or so. But another quick question. Hey, will you provide a proposal of your cost along with your 24 to 48 hour initial evaluation?
Yes. So the process at this point in time, I'm not going to ever compel you or push you. I mean, that's why we always say we welcome the involvement of your accountant. We desire that opportunity because there might be other firms that they're not identifying the R&D potential benefit for them too. So again, that initial assessment's on our dime. It typically takes 24 to 48 hours to turn around, and it's a discussion, unpacking what the model shows. Does it make sense to reach back as far as 2017? Does it make sense only to take the credit 2020 moving forward? We're going to talk through all those things, and shortly thereafter is when we would put a proposal in front of you to understand what to expect from a study, how the invoicing works, all those types of things. But it will never be a push.
Great. Well, I think you said something a second ago that was a hot button here. So a lot of people asking, did you mention that this does not apply to an S Corp? Is that correct?
It absolutely does apply to an S Corp. So all tax entity types, as long as you're a federal taxpayer. So if you think about an LLC, a partnership, an S Corp, it's a flow through, right? So the credit gets aggregated or identified at the entity level, but the benefit flows through to the individual shareholder. So it gets their K1, their 1040, and they make the adjustment or pay down their liabilities that way. And how the credit is apportioned out is based on percentage or apportionment of ownership in that S Corp, LLC, pass-through entity. So absolutely, this is for an S Corp and pass-through entity.
Thank you for clearing that up. And then, one question that I've got, does equipment purchases associated with surveying equipment, would that apply?
It won't. If you think about the discussion we had about software, the capital expense, okay, so that someone built that equipment, right? Someone designed that equipment. They get the R&D. Now we get into an area of the business component called techniques. And let's say that you're trying to maximize that equipment, optimize the equipment, program the equipment, set the equipment up. That happens through human intervention, right? That is where potential R&D expenses are going to come in on the equipment standpoint. But it's not going to be just stroking a check. I mean, because if you think about it, it might be a new check, an improvement to an existing check, but it's not technological in nature to sign the check. You need to get all four tests. And that's why some people ask, well, what about training, right? Getting on a flight or travel. That's not going to qualify because, again, it's not technological in nature to get on a plane, get in a car, and go to a training. But it's that know-how that's learned that's then implemented back in the structure of your business where R&D expense is probably going to hit the qualifying mark.
Okay.
Great question.
Yeah, great questions all around, and I expect you to have more follow up. So we are coming up to the top of the hour. We'll have to end it. So just let me speak for everyone. Say thank you, Dawson, again. The subject each year that I feel like we talk about this and then have been partnered up. We've just more and more success with it. So you guys do not be afraid to get a hold of Zweig Group or Dawson directly. There's his contact info. And we'll start working through those evaluations, like you said, in the first couple of days, and really try to lay out the groundwork to find those extra free dollars that we probably all qualify for.
Sounds great. Again, I appreciate everybody. And if you have any questions, just let me know. I'll do my best to help you explore this a little bit further.